All right, welcome to the Explainer. You ever stare at a price chart and just wonder how some traders see a clear roadmap while the rest of us just see, chaos? Well, today we are opening up the Trader's Toolkit. We're going to break down some really powerful strategies, from riding huge trends to catching those explosive moves right at the market open, and help you figure out which one fits you perfectly.
Everything we're about to talk about, it all comes back to this one single idea. Seriously. Before we get into any specific strategy or setup, you have to get this, because understanding why a price moves is the key that unlocks everything else. So here's our game plan for today. We're going to start with the engine that actually drives the market. Then we'll start adding tools to help us read its direction and its speed. And at the very end, we'll lay them all out side by side so you can pick the right tool for the job. Let's get into it. Okay, so you pull up a chart. It's a jumble of red and green candles, right? It can feel completely random, like there's no rhyme or reason to it. The big question is, how do traders cut through all that noise to find a clear signal? It really just boils down to this. It's a constant tug of war between people buying and people selling. Every single strategy out there is just a different lens, a different way to figure out who's winning that battle at any given moment. So let's start with the most fundamental tool for seeing where the real power is hiding.
All right, let's dig into the big one, supply and demand. This concept is the bedrock. It underpins pretty much every other strategy we're going to talk about today. You could say this is the engine that drives the whole market.
Think of it like this. A supply zone is basically a price level that's just jam-packed with sell orders. It acts like a ceiling, pushing the price down. And a demand zone? That's the floor. It's full of buy orders, ready to push the price up. The really key thing here is that these aren't just single lines on a chart. They are entire zones where a massive imbalance of orders is just sitting there, waiting. So how do you actually spot these things on a chart? Well, it's kind of like being a detective. You start at today's price, and you just scan your eyes to the left. You're looking for a big, explosive candle, a huge green one or a huge red one. That's your clue. The little area right before that big move, that's often your zone. And here's a little pro tip. Traders get really excited about fresh zones, areas where the price hasn't come back to visit yet. And check this out. This Apple chart is a perfect example. See those sharp drops? Every single one happens right as the price taps into one of those pockets of high supply. And the big bounces? Same story, but in reverse. They kick off right from an area of high demand. These aren't just random squiggles. The price is literally reacting to these hidden imbalances. Okay, so now we know how to spot the why behind a price move. Let's add another layer, direction. Our next set of tools is all about reading the market's flow, its momentum. Because let's be honest, trying to trade against the main current is a really tough way to make a living.
Think of trend lines as visual guardrails for the price. You just draw a line connecting the bottoms of the pullbacks in an uptrend or the tops of the bounces in a downtrend. A lot of the time, these lines show you exactly where the big institutional players are stepping in to either support or resist the price. Now, this is where things get really interesting. One tool is good, but combining them, that's a total game changer. When you find a strong demand zone that lines up perfectly with a rising trend line, that's a powerful concept called confluence. It's like a flashing neon sign for traders, because now you have two completely separate reasons to believe the price will react right there. It just stacks the odds in your favor. And here's what happens when those guardrails finally give way. This Nordstrom chart shows a trend line that held up again and again and again. But look at what happens when the price finally just slices right through it. That clean break is a huge signal that the sellers have finally taken control, and the whole trend might be about to reverse.
Okay, so trend lines help us see the overall direction. But when exactly do you enter a trade while you're in that trend? That's where a system like ICC comes into play. It stands for indication, correction, and continuation, and it's basically a simple three-step recipe for trading pullbacks in a trend.
And if that sounds a little complicated, don't worry. Like this trader on Reddit points out, when you really look under the hood, it's using the exact same principles of supply and demand that we've already covered. It's just a more structured, rule-based way of applying them.
So here's how it works. Step one is indication. That's when the market pushes to a new high or a new low, basically showing its hand. Then comes the correction, which is just a pullback. And this part's important. You do nothing here. You wait. Your entry signal is the continuation, when the price breaks out of that little pullback and tells you the original trend is back on.
All right, let's totally switch gears now and add a very different kind of tool to our kit. This one isn't about deep market structure. It's all about speed, timing, and one very specific part of the trading day.
Meet the opening range breakout, or ORB. This is a pure momentum play designed for the absolute chaos of the market open. The idea is really simple. The first 15 or 30 minutes of the day are often wild and volatile, so you just draw a box around the high and the low of that first chunk of time, and you trade whichever way it breaks out, hoping to catch the first big directional move of the day.
And this brings up a huge dilemma that every trader has to face. Do you want to be early or do you want to be right? ORB gets you into the action fast, but that early morning noise can give you a lot of false signals. On the other hand, waiting for more confirmation, like with an ICC setup, means you might get in later, but you'll probably have more confidence in the trade.
The rules for ORB are super mechanical, which is why a lot of people love it. You wait for the first 15 minutes to pass, you mark the high and the low of that range, and you enter as soon as a full candle closes outside of it. And the best part? Your risk is perfectly defined right from the start. Your stop loss just goes on the other side of the box. Simple as that.
Okay, we have looked at a bunch of different tools, from foundational ideas like supply and demand to pure speed plays like the ORB. So the big question is, how in the world do you decide which one to start with?
Now, before we compare them, it's helpful to know that a lot of these tools, especially things like supply and demand and ICC, are part of a much bigger philosophy that people call smart money concepts. The whole idea is to stop thinking like a small retail trader and start trying to track the footprints of the big institutions, the so-called smart money that actually moves the markets.
This table really brings it all together. So if you're a patient trader, someone who likes to find those major market turning points and wait for the price to come to you, then supply and demand is your game. If you're someone who just wants to trade with the flow and ride the big waves, then trend lines and ICC are for you. Trend lines give you the overall structure, and ICC gives you the specific rules for getting in. And finally, if you're an active day trader who can be there for the market open and you love speed, then ORB is the tool for you. It's purely time-based.
Ultimately, it all comes down to answering these questions about yourself. Are you the kind of person who needs a lot of confirmation before you act, or do you thrive on moving fast? Do you get more satisfaction from following a long, established trend, or from trying to nail the exact moment it reverses?
Because here's the secret. The goal isn't to use every single tool all at once. The goal is to find the one that just clicks with your personality and your view of the market, and then to become an absolute expert with it. So, now that you've seen the toolkit, which one are you going to master first?